Okay, guys. Hi, and welcome everybody. This is Boris Schlossberg. We'll be taking a look at a very in macro land, with the most dominant theme, of course, being the fact that we have four, not one, not two, not three, but four central bank decisions on our plate today, this week, starting with obviously the most important one on Wednesday with the Fed. The market is anticipating 75 basis points, which at this point would be a relief, given the fact that we had this enormously sharp CPI number that came out last week that shocked the market. And as a matter of fact, you can make the argument that the market continues to be shocked by this number, as we've just done nothing but slide down in all the equity indices as a result of that CPI number, on fears that the Fed is going to have to become even more tougher on monetary policy. There is a whisper numbers going on right now that the Fed might raise fully 100 basis points as kind of shock therapy for the market. If that were the case, it would certainly be a very, very tough blow to equity longs. Even though market may be mentally prepared for it, the actual reality of a 100 basis point rate hike, which would really, really dampen credit markets, and more importantly, put us on a path well into the 4% rate very, very quickly, would be a very, very difficult and dangerous macro move. Not the least of which, first of all, it would certainly dampen consumer sentiment. It would certainly dampen credit. But more importantly, and perhaps most dangerously of all, by raising rates so far, so quickly, the Fed is really wreaking havoc with the budget of the United States of America. As you are well aware, the U.S. has a massive budget deficit, which it needs to finance. And one of the most important tailwinds for fiscal policy over the last decade has been the fact that you could essentially increase budget without really increasing the cost to the Treasury, because interest rates were so low. Debt service, which is really the only thing that matters, because when you think about federal budgets, especially big sovereign nation budgets like US or Europe, nobody really cares about the underlying amount of money owed. That money just simply gets rolled. What's of most pressing interest and most pressing concern to anybody who is managing the fiscal budget is debt service. When we were at zero interest rate policy, debt service was minuscule. Even at 2% rates, debt service was doable. But if we go to 4% rate, debt service could comprise, I'm not quite sure what the actual numbers are, but it could be as much as literally 20 to 25% of the overall outlays. In other words, fully a quarter of every federal expenditure done on a budget could be debt service. That's where it becomes extraordinarily dangerous for monetary policy to effectively destroy the economy. And I think that's what the Fed is very much concerned with. So in my opinion, it would be extraordinarily surprising if they overweight the near-term inflationary pressures over the much more longer-term concerns. They're going to go too far, too fast, and that's going to create very, very difficult conditions for fiscal authorities. So the Fed, of course, is going to set the scene for everything. Then after that, we have the Swiss National Bank coming up on Thursday. Then we have the BOJ, I believe, that night. We have the BOJ that night after the Fed. Then we have the Swiss National Bank. Then we have the UK, the Bank of England monetary policy votes. So you have all of these central bankers. All of them are definitely going to be tightening policy, with the exception of the Bank of Japan, which continues to just sort of hold out, which is the reason why dollar yen has been so strong. So you have really a very, very strong monetary policy cast to where the markets are going to be going this week. And we're going to end up the week with kind of a final reading of the flash PMIs from Germany, from Europe, and those are going to be of much smaller interest, but still going to be interesting to see just how well or how poorly the European economy is weathering the economic shocks. Overall, though, it's really going to be a focus on just how strangling the monetary policy will become. And if we get into a situation where the Fed raises 100, and of course the BOJ is going to stay relatively stationary, that really opens up huge amount of discontinuity in, well, let me pull up the chart here. I want to go to FX. We're going to go to FX. Let's take a look at FX first and foremost, and then we can take a look at everything else. By the way, what you're looking at here is our proprietary BKForex, my own proprietary indicator called Bounce, which is designed to catch both turns and trends. As you can see here, dollar CAD, this is a 1 hour chart of dollar CAD. You can see how well it catches the trend moves in the, and as you can see right now, we're just relentlessly selling everything in the equity land in front of the monetary policy conditions. So you can see, like, sort of, this is the breakout label. This is the top label in dollar CAD, and you can kind of see there's a strategy we trade that trades both the breakout momentum moves as well as very effectively the reversal moves in all of these trades. It's proprietary indicator available to anybody who is a BK member. So if you'd like to join us, feel free. All you have to do to become a BK member, if you're an Eightcap member, is to just deposit money in your account. Just email me or ask your Eightcap representative how much money into that. If you already have an account, you just simply need to top it off. If you are thinking of opening an account, there's no better reason to do it than just to open an account and get all of our services for free, which is all of our signal services, my live trading services every day, and all of the stuff that we do here, as well as the indicators that help you, that move you all the way through the travails of the market. So anyways, let's take a look at dollar yen, which is what I really want to take a look at. So we have, big burst. I think this was the CPI data, right? And we've basically held above the CPI data lows, consolidating. What will be interesting to me is this: if Fed goes 100, what are we going to do with this 145? There's sort of two possible scenarios here. If the market is just convinced that we're on a hell high road to 5% rates, then we're going to really run through the 145, and we're going to put 150 into the path. And the BOJ may be way too late in trying to react as intervention on this move, because the market will just simply overwhelm them. The other possibility is if we kind of go to 75, there's a really strong possibility that we could double top at this 145 level, because we're certainly so grossly overbought that a corrective move from these levels very much is due. So one way that we would trade this in the BK room is we would look to see if the price hits fresh cycle highs. So this is the RSI cycle, most recent RSI cycle. These are the fresh cycle highs around 145, right? If it hits the fresh cycle highs on price, but does not necessarily hit fresh cycle highs on RSI, so it doesn't really go into overbought territory. More importantly, if it does that and then starts printing red candles, that would tell us that this is a reversal, not a continuation, and we would be able to short this very nicely, probably around the 144.50s, possibly to move to a 141. So we'll be watching that as probably the most seminal FX trade of the week, because you have this incredible disparity between the BOJ and the Fed, and this will be, I think, the battleground that a lot of people in FX are going to be looking at. Now, as to other trades in the market, Euro really scraping the ground here at the parity level. We had a couple of you could say false breakouts. There was one or two. The thing that really broke the Euro's back was the CPI number here, which completely reconfigured the rate expectations of the U.S. versus the ECB, the Fed versus the ECB, and that's what's happened. However, we held bid here for quite a while, and here we're going to be looking for a sort of a reversal to the other side. In other words, let's say price is kind of making fresh lows around the low of the last cycle, but not being confirmed by momentum indicators. And if we get a green candle here, now this is going to be completely different during the Fed day. So we're going to be analyzing it at that point, at that time. But right now, if we're sort of looking for near-term trades, a green candle here in the euro would put us long euros, at least for the near term, for a possible, I wouldn't be trading this for more than 30, 40 pips to the upside prior to the Fed notice. But if the Fed comes out at 75 basis points instead of 100, it's really feasible that we could have a couple of 100-point move in the euro on just relief rally alone. So definitely worth watching that as we go forward. Cable is a basket case, in my opinion. I think the BOE is stuck between a rock and a hard place. It doesn't really have control over its currency, control over its economy. It's a tiny little country in a sea of much bigger giants, and its own fate has been sealed by Brexit, which is why it's not inconceivable for us to imagine a 110 pound over the before the end of the year as interest rate as. The point being is that if they raise interest rates too high, they will strangle the UK economy. And if they raise interest rates too low, it's going to really hurt the pound to the downside. So I think pound is vulnerable because they're going to err on the side of caution in terms of raising rates and causing a massive recessionary problem, especially with a new government in that's going to be very, very averse to further economic pain on society. So I think cable really is looks the most vulnerable. This, by the way, creates one of my favorite trades for the quarter, which is the long euro pound trade. If you look at the crosses, that's you can see that trade has just been performing super well. We are now essentially at the 88 level, and I think that's going to be very, very telling because as we go through the 88 and hold it, that could be a massive breakout in a much longer term time frame. So we can go to the 4-hour time frame. And we see that all of every kind of major time frame is showing us very, very powerful moves to the upside. We took out yearly highs over here at the 87. We're moving towards the 88. There is no reason to think that this could not end up at 90 before all is said and done. So this is an interesting longer term trade, in my opinion. Definitely worth watching. Next. So we talked about the pound, we talked about the euro. Let's take a look at the commodity currencies, okay? Let's go back to the 1-hour chart. Dollar CAD, this is, again, dollar strength, and you see dollar strength just persisting here on a very, very strong basis. So, again, Fed 100 basis point hike on the Fed, we're $135 CAD. If you're confident that that's what we do, then we're definitely $135 CAD. Kiwi already taken out the 60, and again 1% hike on the Fed. Kiwi comes back down towards the 58s. It's really it's really amazing to think about this. Like, this was a 75-cent trade, and this could be ultimately maybe a 50-cent trade down the road. But for now, we're plumbing the lows. Especially the interesting thing is if we start we're going to make fresh lows on the charts with fresh cycle lows, meaning RSI lows goes to 30. RSI right now is what? Let me just make sure I give you. Let me see what the RSI is. It's 44. So we're still oh, sorry, I'm on the wrong one. I'll go to the hourly. On the hourly, we are at 34. So we're close to making fresh RSIs to the downside. And that obviously creates further downside pressure on the Kiwi. And the Aussie, sort of the same thing now. We took out long ago, we took out the 70s, and we may be moving towards the 65s as a big area of support. Overall, there's no doubt that the dollar is grossly overbought, but it doesn't mean that it can't become even more overbought, especially if the interest rate policy turns even more supportive towards the dollar. That's yet another reason why the Fed needs to be very careful. Them strengthening the dollar so far, so fast could have massive, massive ripple effects throughout the world economy on trade as everybody scrambles to remember everybody buys everything in dollars as far as commodity inputs. So it's very, very difficult to manage your economy when your cost of goods really continues to go up and up and up. So my view is the Fed stays 75. Excuse me, stays 75, and that creates a little bit of a benign bounce for all the risk assets, at least for the near term, as the market averts the strangulation scenario, which is what a lot of the bears are arguing for. So that's FX. You can see at the same time that crypto and everything else is also just collapsing. One of the more interesting things about crypto that we talked about is Ethereum went to a fork, and instead of rising, it fell. To me, this is just simply a clear sign that crypto is in a significant bear market, that it has zero economic value to the world, and people are just realizing it was the pet rock of the 220s. It was a fad that is losing its luster, and until crypto proves any kind of real world functionality that literally anybody can use, not just little geeks who play games on Twitch, it just looks like a move to zero across all these assets. So I don't have anything intelligent to say on crypto except that it's just all red, and whatever bounce we have are going to be dead cat bounces until we have some sort of a fundamental shift as to why people will think crypto has any value. Right now, what the charts are basically showing is that crypto has no value, and it continues to decline. Ethereum taking out 1,000 is going to be a very, very, very ugly psychological factor to many people. Bitcoin taking out 15,000 is going to be a very, very psychological factor to many people. And if we get to those levels, that's going to really make crypto the most reviled asset. Now, you may want to be buying it at that point if you think that it has long-term value, but I've yet to have anybody demonstrate to me it has any short-term value. So it's going to be interesting, to watch it. For now, it's just basically sell the rally, constant idea in crypto. Now, gold, sort of similar type of situation. Gold is making this very, very tepid little base. Let's go to maybe the daily chart here. You can see the daily chart. Gold is making this, this very, very tepid little base at a 1660 level. But you really have to close your eyes and pray that this is the bottom, because otherwise we just, we basically don't have any true technical support here. And gold is also sort of in the same situation. Higher yields make gold very unattractive because this is a carry cost asset. In other words, you need to pay money to finance it. It yields you nothing. And although people sort of make this assumption that inflationary environments gold really thrives, that's certainly not been the case. People are not interested in storing gold as a store of value because they realize, I think what's interesting is that in the 60s and 70s and 50s, there was still this cultural allure of gold. One of the things that crypto did was destroy any concept of gold as anything of actual value. If you believe that anything can be a store of value, then why would you want a gold brick be a store of value rather than a USB hard drive? And although crypto itself is kind of collapsing, it's taking gold down with it, maybe as a realization that investors at this point have zero interest in carrying bricks of useless metal as some sort of a store of value for which other investors are going to pay them money for. You need income generating assets to have store of value. And I think people are finally realizing that gold ain't it. So maybe it's also certainly the price action is showing that there's a lot of disdain for both gold and crypto at this point. And it's not not an asset that you want to, unless you just sort of want to trade it for a hope and a bounce that shows any kind of sustained long-term rally conditions. And then finally, let's take a look at gold. Oil. Oil is, we've been arguing for quite a while that oil is a sort of a 70 to 90 trade. That's really its near-term range. Oil is also getting sold very hard right now on, I think, global recessionary fears. There was an article today that Tesla is shutting down some of its factories in China. That's a very minor empirical point that could really give you a view onto a much bigger major idea, which is that this is the part of the Chinese economy that is most sensitive to, quickest to respond to contraction in demand. And if Tesla is shutting down showrooms, that means Chinese demand is collapsing. That means China is effectively in a recession. And if China is in a recession, demand for oil is going to be much more tepid. So you really could have a situation where oil could come back down and test the 70s and really destroy all of the oil bulls who've been so bullish at the 130 and are now just going to be liquidating into that move. And then last but not least, the very, very tough equity trade, which has also been incredibly difficult. This is the CPI, and we've just had 5 consecutive days of negative trade. That's tough to absorb. Are we coming into that 3,000 support level? Yes, we are. So if there's any kind of a technical bounce, it'll be somewhere around here in the next 500 points. Should you start accumulating at this point? It all depends on your timing and how you see the trade. If you think that there's going to be a V-shaped bounce because a 75 basis point cut may create a big short covering rally, yes, you kind of have to buy ahead of time, because by the time it pops, you won't be able to get it. But if you think that whatever rally we have will be just consolidated on the bottom here, you may want to give yourself some time before you try to trade the turn trade here. 100-point cut will take us below this level. And then we're just going to be really struggling to repair this. There'll be some very sharp V-shaped recoveries, but before the V-shaped bounces, there'll be some really just full sellout modes. We're going to take out the lows at 100 basis point cut. So be aware of that and understand your levels. So that's pretty much it. That's how the week shapes up. We're certainly going to be focusing on the Fed this week as a key tell barometer for everything else that goes forward. And as I said, my baseline scenario is that they will not shock the markets with 100. They'll stay at 75 to try to preserve the status quo as we go forward. I'll meet up with you guys on Wednesday ahead of the FOMC, and we'll see where things stand at that point. Meantime, wishing you guys the best of luck, the best of trading, and I'll see you guys in the middle of the week. Take care.